The Roth conversion. Deadline. Most Americans will miss 2025 to 2028. Between now and 2028, there's a financial window open for millions of Americans that could save them and their families tens of thousands of dollars in taxes. And most of them have no idea it exists. It's not a loophole. It's not a gray area. It's a well-understood strategy that takes direct advantage of a specific set of circumstances that are converging right now. Circumstances that won't all be present at the same time again for many years, if ever. The strategy is Roth conversions. And the window is the 3 years between 2025 and 2028, a period defined by historically favorable tax brackets, a predictable income landscape for many pre-retirees, and a set of rule changes that make acting now significantly more valuable than waiting. Here's the brutal truth. Most Americans who are eligible to take advantage of this window won't, not because they can't, not because the math doesn't work in their favor, but because they don't know the window exists, or they understand it vaguely but assume they have more time. By the time they act, the circumstances that make this window so valuable will have partially or fully closed. In this video, I'm going to explain exactly what makes 2025 to 2028 so significant, who is most positioned to benefit, how to calculate the right conversion amount, and what happens if you miss it. Section 1. Why this window is different from any other. To understand why 2025 to 2028 is a specific and time-limited opportunity, you need to understand three things that are true simultaneously right now, and may not all be true at the same time again. Factor 1. The current tax brackets are historically low. The Tax Cuts and Jobs Act of 2017 reduced federal income tax rates significantly. The 22% bracket, the 24% bracket, the 32% bracket, all were reduced from the rates that existed before 2018. The One Big Beautiful Bill Act of 2025 has made these rates permanent. But that doesn't mean rates will never rise again. It means the current legislative framework keeps them in place until Congress changes it. Given long-term fiscal pressures, many tax analysts believe rates are more likely to rise over the next decade than fall. Converting 401k and traditional individual retirement account money to a Roth now at current rates means paying a known current rate rather than an uncertain, potentially higher future rate. Factor 2. The pre-required minimum distribution income window. For retirees who stopped working between 60 and 67, there's a period where taxable income is at its lowest point in decades. Earned income has stopped. Social Security may not have started, or has recently started, at a modest level. Required minimum distributions haven't begun. In this income valley, tax brackets that would be inaccessible during peak earning years are now within reach. A married couple with $40,000 in income has access to the 12% bracket up to $100,800 of taxable income, meaning they can convert nearly $61,000 from traditional accounts to a Roth at 12% with their remaining bracket capacity. That window doesn't last indefinitely. Social Security, cost of living adjustment increases gradually raise provisional income each year. Required minimum distributions begin at 73 and grow annually. The income valley is a finite period, and Hametz's floor is rising over time. Factor 3. The 2021 required minimum distribution reckoning. For Americans who are now 63 to 68 years old, required minimum distributions begin in the next 5 to 10 years. The larger your traditional individual retirement account or 401k balance at 73, the larger your mandatory annual withdrawals, regardless of whether you need the money. Every dollar you convert to a Roth between now and required minimum distribution age is a dollar that will never generate a required minimum distribution. Converting $200,000 over the next 5 years at 12 to 22% rates eliminates the required minimum distributions that $200,000 would have generated for the rest of your life. Required minimum distributions that might otherwise arrive at 24% or 32% rates once Social Security is fully in payment and other income has accumulated. The convergence of low current rates, a low income window, and the approaching required minimum distribution clock is what makes 2025 to 2028 genuinely distinctive. All three factors are present simultaneously for a large cohort of Americans right now. Section 2. Who is most positioned to benefit? Not everyone benefits equally from this window. Here's the profile of the people for whom this strategy is most valuable. Recently retired, not yet receiving Social Security. If you retired in the last 2 to 3 years and haven't yet claimed Social Security, your taxable income may be at its lowest point since early in your career. This is the ideal profile for aggressive Roth conversions. Large available bracket capacity, Low other income and a clear timeline before Social Security and required minimum distributions change the picture. Age 60 to 68, with significant traditional individual retirement account or 401k balance. The larger your traditional balance, the larger your future required minimum distribution exposure, and therefore the larger the benefit of converting a portion now. Someone with $1.2 million in a traditional individual retirement account at 65 faces projected required minimum distributions of $45,000 to $80,000 per year from age 73 onward. Converting $150,000 per year for 5 years reduces that exposure substantially. People whose income will rise significantly in future years. If you expect your income to increase through Social Security, cost of living adjustment, increases, inheritance, rental income, the sale of property or a business, or a spouse returning to work, converting now at a lower rate locks in a favorable outcome. Before that income rise changes your bracket position. People with Roth eligible heirs in higher tax brackets. A Roth individual retirement account inherited by your adult children is one of the most tax-efficient assets they can receive. They inherit it tax-free, it grows tax-free, and they can withdraw it tax-free, subject to the 10-year distribution rule. If your adult children are in the 24% or 32% bracket, the value of passing a Roth, rather than a traditional individual retirement account to them, is the difference between them receiving the full inheritance and receiving 68.76 cents on every dollar. People who are not positioned to benefit. If you're still in your peak earning years with high taxable income, conversions at 32% or 35% are rarely advantageous unless you have specific reasons to believe your future rate will be substantially higher. If your traditional balance is modest, under $100,000, the required minimum distribution exposure is limited and the urgency is lower. If you don't have funds outside the individual retirement account to pay the tax on conversions, the conversion becomes less efficient. Section 3. The maths. How to calculate your optimal conversion amount. The most common question about Roth conversions is, how much should I convert? The answer depends on your specific numbers, but here's the framework that works for most people. Step 1. Calculate your current taxable income. Start with all your current income sources. Social Security, up to 85% taxable. Pension income, part-time earnings, investment income, rental income. Subtract the standard deduction, $32,200 for married filing jointly in 2026. That's your current taxable income before any conversion. Step 2. Identify your target bracket ceiling. For most people doing Roth conversions, the goal is to fill to the top of the 22% bracket, or in some cases, the 24% bracket, without crossing into the next tier. In 2026, for married filing jointly, top of 12% bracket are $100,800 of taxable income, gross income of $133,000. Top of 22% bracket, $211,400 of taxable income, gross income of $248,600. The gap between your current taxable income and your chosen ceiling is your available conversion capacity for the year. Step 3. Account for Social Security interaction. Every dollar you convert raises your provisional income, which can cause more of your Social Security to become taxable. If your provisional income is near the $44,000 threshold for married couples, a conversion that pushes you above it will generate additional taxable Social Security on top of the conversion amount itself. This is the Social Security tax torpedo. Model the interaction carefully. In some cases, it makes sense to convert only up to the threshold, where additional Social Security taxation kicks in rather than beyond it. Step 4. Check income-related monthly adjustment amount thresholds. Medicare uses income from 2 years prior. A large conversion this year affects your Medicare premiums in 2 years. In 2026, the first income-related monthly adjustment amount tier kicks in at $106,000 for individuals and $212,000 for married couples. Crossing this threshold costs approximately $900 per person per year in additional Medicare premiums. If your conversion would push you just over an income-related monthly adjustment amount threshold, consider reducing the conversion amount slightly to stay below it. The tax saving from the smaller conversion is often more than offset by 2 years of income-related monthly adjustment amount surcharges. Step 5. Pay the tax from outside funds. This is critical. If you convert $60,000 and then withhold tax from the conversion itself, you've effectively only moved $47,000 into the Roth. The $13,000 withheld for taxes has left the tax-advantaged environment, and if you're under 59.12, It may also trigger a 10% early withdrawal penalty. Paying the tax bill from a taxable brokerage account or savings account means the full $60,000 lands in the Roth and compounds tax-free. This significantly improves the long-term outcome of the conversion. The Roth conversion. Modeler inside retirement. Ready US automates all 5 of these steps. You enter your income, your account balances, your Social Security timeline, and your income-related monthly adjustment amount position. And it calculates the optimal annual conversion amount, the tax cost, and the projected long-term benefit. It takes the guesswork out of what is otherwise quite complex arithmetic. Link in the description. Section 4. The 5-year plan. What this looks like in practice. Let me show you what a deliberate 2025-2028 conversion strategy looks like for a real household. David and Carol, both 64. David retired last year. Carol is still working part-time, earning $22,000. They have $180,000 in Social Security income combined, not yet claimed. They have $950,000 in traditional individual retirement accounts and $120,000 in a Roth. Their living expenses are covered by Carol's income and savings. Their taxable income currently, $22,000 minus standard deduction, $32,200 below the standard deduction, so taxable income is effectively zero from earned income alone. Available conversion capacity to top of 2% bracket, approximately $211,400. But the Social Security torpedo and income-related monthly adjustment amount concerns suggest staying below $212,000 gross income, so they target approximately $180,000 in gross income, meaning a conversion of roughly $158,000 this year. That's more than they can realistically do in 1 year. So they plan over 4 years. Year 1, 2025, convert $120,000, pay approximately $22,000 in tax from savings. Year 2, 2026, Carol retires, income drops further, convert $130,000, pay approximately $24,000. Year 3, 2027, Social Security not yet started, convert $130,000, pay approximately $24,000. Year 4, 2028, claim Social Security. Reduce conversion of $60,000 to avoid income-related monthly adjustment amount issues. Pay approximately $13,000. Total converted over 4 years, $440,000. Total tax paid on conversions, approximately $83,000. Traditional individual retirement account balance reduced from $950,000 to approximately $510,000, accounting for conversions, growth, and living expenses. The benefit. Their annual required minimum distributions at age 73, starting in 9 years, will be approximately $19,000, rather than the projected $36,000 on the original balance. Over 20 years of required minimum distributions, the tax saving from the lower mandatory withdrawal rate is conservatively $80,000 to $120,000, more than the $83,000 they paid in conversion taxes. Their Roth individual retirement account, now at approximately $660,000 including conversions and growth, generates no required minimum distributions. It grows tax-free. It can be passed to their children tax-free. The tax bill they paid over 4 years was the price of admission to that outcome. Section 5. What happens if you miss the window? Let me be honest about what happens if you don't act during this window. The options don't disappear entirely. Roth conversions remain possible at any age, in any year. But the favorable conditions narrow. From 73, required minimum distributions start, and these can't be converted. You must take required minimum distributions as income before converting anything else. The required minimum distribution itself pushes your taxable income up, which reduces the available bracket capacity for additional conversions. You are converting at a higher marginal rate, or not converting at all because the rate is no longer advantageous. If tax rates rise, which represents a genuine risk given long-term fiscal trajectories, the cost of conversions increases. Money you could have moved at 22% in 2026 might be moving at 25% or 28% in 2032. If your income rises, through cost of living adjustment, increased Social Security, pension income, inheritance, or investment income, your bracket position worsens and the conversion opportunity shrinks. None of this means waiting is catastrophic, but it does mean waiting has a cost. A real calculable cost in higher conversion rates, higher required minimum distribution rates, and fewer years of Roth compounding. The window doesn't slam shut on a specific date. It closes gradually, year by year, as the conditions that make it favorable deteriorate. which means the optimal response to knowing the window exists is to act now, not to plan to act later. Between 2025 and 2028, a large cohort of recently retired Americans has a genuine and time-limited opportunity to reposition retirement wealth from a taxed environment into a tax-free one at historically reasonable rates during the lowest income years of their adult lives before required minimum distributions remove their flexibility. Most of them won't take it. Not because the math doesn't work. Because they don't know the window exists, or they know about it vaguely but assume they have time. If this video has convinced you that you might be in that window, the next step is to run your numbers. How much can you convert this year while staying within your target bracket? What's the tax cost? What's the long-term required minimum distribution reduction? The Roth conversion modeler inside Retirement Ready US is built specifically to answer those questions. Modeling your bracket position, Social Security interaction, income-related monthly adjustment amount exposure, and the long-term tax saving from a multi-year conversion strategy. Link in the description. I've also linked my broader videos on Roth conversion strategy and required minimum distributions. They provide the fuller context for why this window matters so much. Hit like if this was valuable. Subscribe for more U.S. retirement tax planning content. I'll see you in the next one.